and welcome to this very special webinar, Headwinds and Tailwinds, Navigating Indian Financial Markets, brought to you by Refinitiv and Moneycontrol. The topic for this session is the roadmap to India's bond market, and I'm your host, Ruchira Sharma. With the COVID-19 pandemic and its hard-hitting impact on economies, investors are keen to make the most of their buck, and rightly so. There seems to be a rising interest in putting hard-earned money in safer asset classes like bonds and deposits, which offer regular returns with lesser volatility than equity. On this exclusive show with a panel of experts, we will try to explore key trends, developments in the bond market, and also try to decode how data-driven insights can drive performance and find out ways to create an ideal fixed income portfolio. So let me begin by introducing my esteemed panel of guests. Mr. Rajiv P. Pawar, Head Treasury, Ujjivan Small Finance Bank Limited. Welcome to the show. It's a pleasure having you with us. Mr. Rajay Sinha, CGM Global Markets, SBI. Mr. Shankara Sambavisan, Proposition Sales Manager, Refinitiv and LSEG Business. Thank you for joining us. And Ms. Lakshmi Iyer, CIO, Fixed Income and Head Products, Kotak Mutual Fund. Well, thank you all for joining us. And as we all know, the Indian debt market has been developing rapidly, and the GOI securities being the largest, and the daily trading volume is almost 10,000 crore rupees. So today we will discuss the entire spectrum of fixed income options and try to decode how to build a roadmap to India's bond market. So I'd like to begin with you, Lakshmi. What do you think is the present momentum like in the Indian bond market? Because I have a report here by Crystal which says that the Indian corporate bond market is expected to double to a whopping 65 to 70 lakh crore by 2025. So what's your take here?
Yeah, hi, Ruchira. Clearly, there is, a lot of width and a lot of depth as far as the corporate bond market in India is concerned. A lot of corporates in India Inc. have found raising monies through the corporate bond or the capital market route a very potent source of fundraising, and this is going hand in hand with their equity raise as well. Incrementally, we also have seen, especially in the current phase, given that last 15-16 months have been characterized by the pandemic, we've actually seen a tepid credit growth offtake from the banking system. Aggregate credit offtake is roughly in the band of 6 to 7%. Of course, there may be some banks which are north of 10% and some which are south of 6%. But that's where we are. And in that kind of a scenario, the buoyancy in the capital markets, whether it is for capex, whether it is for working capital cycle, or it is just a refinance, it is found favor with multiple set of investors. Another interesting trend to note here is that given the depleting pace or given the fast pace of depleting interest rates, though we have bottomed out to a large extent here, we've also seen the retail stroke HNI India participate in the corporate bond market route through either public listed debentures or through issuances that we have seen. So I think all in all, there is a reasonable vibrancy, especially in the primary market. The caveat here being that the secondary market may not be as liquid, but certainly we have moved leaps and bounds compared to where we were a few years back.
So Mr. Rajiv, I'd like to come to you. What is your insight here? What is your take on the present momentum in the Indian bond market?
Well, the momentum dropped a lot in the past 2 years after, if I talk about the government bond market. The market trading hours were reduced. The volumes also came down in the bond market. If you look at the corporate bond market, if you look at the SEBI data, in 2020-21, we had, I think, more than about 1,300 odd issuers, 28 lakh crores was raised. But most of it, I think almost about 84% of it was raised by AAA kind of issuers. And maybe another 10-12% was by AA kind of issuers. So the trickle down to the lower grade investors or issuers is not really happening. So most of the money is staying safe, which is logical also given the current environment that we have, that you have monies going into govies and you have it going into the better rated corporates. So momentum is there. If you look at the sovereign bond market, the momentum is there, largely driven by two factors. One is the issuance happening, and the other side, the absorption, and the absorption is largely the Reserve Bank of India. So it's a very controlled kind of market, or a market which is like in a slow glide in terms of rates. So there is momentum, but I would say there is it's a controlled kind of momentum which is there as of now.
All right. And Mr. Rajay, I would like to get you in here at this point. Whenever we analyze the domestic bond market, apart from global factors, RBI, of course, plays a key role in shaping the market trends. So, what do you think is the RBI influence on the bond market? And as we know, the repo rate has been going down, has seen a downward trend. So, what are your thoughts here?
You are absolutely right. RBI has significant influence on the bond market, especially through the policy rates, which actually also reflect the growth and inflation projections. Especially RBI's role in controlling the rate, or rather guiding the rate, becomes extremely important given the fact that the inflation projection given by RBI, the dot plots, etc., are taken very seriously by the market. Another important thing is that the liquidity management. Essentially, if you look at the present circumstances, for example, it's liquidity that is driving everything. And liquidity management to a large extent is guided by Reserve Bank of India. So apart from inflation projection, policy rates, it's liquidity management, and of course, some cyclical or short-term measures like GSAP, like switchage, by which RBI tries to guide the yield curve or a part of the yield curve. So in that sense, RBI's role in overall, bond market becomes extremely significant when it comes to yield curve. Apart from that, if you look at the overall market development, Indian bond market actually, if you start with GSEC, has been guided for the last 20 years by Reserve Bank of India. The product and processes that they have changed, the guaranteed settlement, one of the best settlement system when it comes to fixed income instrument, is here in India, and RBI has played a crucial role. So far as financial infrastructure is concerned, RBI is the guiding force actually. And periodically, if they keep talking to the market, they try to understand the requirements of the market, and accordingly they fine tune the policies, etc. So I would say that they play a very crucial role in overall development and growth of bond market in India.
Okay, I'd like to bring you in, Mr. Shankara here. What is your take on this? Do you think that RBI is expected to keep the repo rate at this one, and to support economic recovery, to keep it at a neutral 4% and keep a low interest rate regime? And what do you think is the resulting impact of that on the bond market?
Right. Thank you, Ruchira. So to me, I'll probably go with the data and consensus, right? So for us, you already have enough market experts here, but I would rather go with the data and consensus. So if I for example, look at the projections of Reuters polls, we are expecting the rates to remain constant this year. The polls do expect that the repo rates to rise only probably early next year, probably around Q1 next year, and that's how when I say the poll, it's obviously a consensus of all of these market participants, right? So when we look at it from that perspective, that's how it's looking like. But having said that, there has been some bit of traction around the yields rising in the recent terms, with obviously a lot of emphasis on inflation, how that's going to pan out. So as of today, the polls do say no major rise in repo rates till about first quarter next year.
All right. And since you're in this space, you're a leader in the space, so tell me, what are the biggest data challenges that are facing bond traders today, and what does it mean for the investors?
So typically, if I look at a trader's mindset, right? So the first and foremost key thing is, do I know where the market is trading? Where is this particular bond being priced at? It would be primary, maybe secondary. A lot of challenges obviously happen in the secondary market. Now, to that extent, obviously, it's already been fairly established that India is one of the markets where we do have fair bit of reporting happening on that space. But a lot of that is again limited to AAA or AA papers, and obviously GSEC is very, very liquid on the NDSM platform. So in terms of data, we are fairly limited to that. And when someone wants to look at a slightly more illiquid security or slightly more a security which is maybe rated, triple B or B or something which is not as creditworthy as a triple A paper, right? There is not enough liquidity, and that's where the challenge is for most people. And when that data doesn't exist, your liquidity doesn't come, and it's just a vicious cycle, and it's very difficult to break that cycle. So we have globally obviously done a lot of work in that space, and we are hoping that we'll be able to do a bit more around using unstructured data on that front to bring in more transparency and more price transparency to some of these illiquid instruments.
All right, thank you for that. Lakshmi, I'd like to bring you in here. What do you think are the other factors which are changing the market dynamics? The bond market, much like the equities market, has been witnessing an explosion of market data driven by technology and legislation, the rise of electronic trading. So tell us, what are your thoughts on this?
So, if you dissect the Indian bond markets into two pieces, one is the Government of India securities market, which is a sovereign market, and the non-SLR market, which is the corporate bond market. There is no doubt that, there has been a migration from the OTC or the over-the-counter, markets, which used to be there in government bond markets, to an electronic, market, as Mr. Sinha also alluded to. So that has magnified or amplified the volumes quite meaningfully. Earlier, it used to be that the general question in the trader's mind was, okay, who's buying, who's selling? And if there was like a big entity buying, then, all the sellers used to vanish and vice versa. Now, to be very honest, whether it's $1 million deal or a $1 billion deal, it's all price discovery. And if you move this on to the corporate bond market, we still are at that scenario where it used to be at the time where the OTC market for government bonds were there. So I think the way forward would clearly be that you have some sort of a mechanism to migrate the corporate bond market also into a trading platform. I know it's not as streamlined as the Government of India securities are, but clearly there is, some baby steps which has been made in that direction. For starters, we have the RFQ, or the request for quote platform, which is just about starting, still fledgling in nature, but that can be built on to incorporate
Absolutely.
more participants, etc. And then that's when you see more and more buoyancy, the way we are seeing in the government bond market.
Absolutely. And the corporate bond market also, even though less liquid, has been fast developing. So, Rajay, I'd like to bring you in here. What do you think are the other factors which are going to change the market dynamics, and how is the proliferation of fixed income data changing the landscape here?
Look, when it comes to standard market data, we have so many agencies, including Refinitiv, etc. So the amount of data is no longer a challenge, especially for established corporates, etc. issuing debt. The challenge that we face is on two fronts. One, new instruments, etc. They are coming and not backed by proper information ecosystem as yet. For example, now we are talking about REIT and infrastructure development funds and similar structures. So we do not have adequate data at this point in time about these things. But this is not about information asymmetry. This information is not equal to anyone. Second issue that we face is retail investors possibly still don't have access to quality data.
All right. But do you think REIT and InvIT, they have seen a positive interest? So do you think they're in competition with the fixed income category?
They are slightly different, but if you consider that the pool of investable surplus is the same, while it's increasing at 8, 10%, whatever, but it's the same. So in that sense, yes, they all are vying for the same pool of resources. So
Absolutely.
in that sense, these are challenges. But if you again think of it, they will replace another sort of borrowing requirements. So it's a challenge, but I think it will help develop the market, especially for different set of issuers and possibly different tenors also. Possibly INVIX and REITs will be looking for longer term, fundraising where it is backed by sufficient collateral, etc. So let us hope. It's early days for INVIT and REIT, but let us see.
All right. I'd like to bring you in, Shankaran. What are the other factors which are affecting market liquidity?
Right. So, I mean, accessibility is key, right? We, like we just spoke about, I think RFQ mode, Lakshmi did mention about it. Now, the more we are able to move, so today, if I look at, the way trading is happening, a lot of it outside the liquid instruments are typically happening over, messages and chats and so on and so forth. So we have to take, maybe steps towards, first getting that data out, right? So we do, some of the entities have actually used some of this data, which is in unstructured format. It's just messages which is coming in, and use some NLP on top of it, natural language processing on top of it, make it a bit more structured so that your traders can actually make a bit more sense out of that. And once you have that data, then you're a bit more confident to trade on top of it. So that's bringing data to the table. The next step is obviously the connecting the market participants, right? So that's key to obviously completing that transaction. So to achieve that, obviously, we've been doing this for years globally. Hopefully, we'll be able to do some more in India as well. The key challenge with illiquid instruments, it's not very simple to say, okay, I just do an RFQ. Somebody requests for a price, I give a price, and we transacted on it. It doesn't practically happen that way. So there's a lot of back and forth between the two entities. In certain cases, there are even brokers involved. That what is it that is the price that I can agree upon in an illiquid instrument. So this workflow is a bit more difficult to achieve than a standard RFQ, which is what we've done. We've actually been able to do in some of the emerging markets in Africa. And once you've done that, then it's about bringing transparency to the market, right? So you have the transacted data. Now it's happened electronically. Now you can actually then further process it via straight through processing and pass it to your internal systems, and obviously report it to the in whichever shape and forms to the regulatory authorities, so that can then be made available to everyone, right? So which already happens. The reporting part of it does happen today, but it does happen with a bit of a lag. So which obviously means that sometimes the data you're looking is a bit stale, and it doesn't necessarily help everyone in that sense. So if you're able to achieve data, transaction, and then the reporting as close to real time as possible, I think that's where the liquidity would definitely grow in the market.
So clearly the adoption the process has to be seamless. But Rajiv, I'd like to bring you in here. What do you think are the attractive factors in the bond market liquidity available on the platform, since you're also using it?
So there are a lot of innovations, a lot of changes. Someone spoke about RFQ, etc., which have come through. But the big problem is that there is a lot of, I won't call it resistance, but hesitancy from people in using it. For example, you look at the RFQ functionality on India, so it's barely used. Even simpler, older products which are there in the market, say strips or floating rate bonds, each of them is used by a particular segment. And a lot of it is to do with the fact that traders, investors are used to dealing in a particular manner, and they prefer to follow that. They don't really want to look at anything new. Some of it is that they have not sort of upgraded themselves to anything new that has come on. And more importantly, it is that things are working fine. I buy a bond in a particular way. XYZ bond goes into A portfolio, something else goes into B portfolio. This is for my long-term portfolio. If I'm a bank, my HTM, something else is for my trading portfolio. We stick to that. You don't really think differently. For example, if you look at something like I was talking about strips. Now, strips are normally said, okay, these are, door to door. You buy it, insurance companies buy it, they'll hold it. But banks can also use it. Suppose you're participating in an LTRO or an SLTRO, one of them, where you need bonds which are for a fixed maturity. You can actually use that, buy them, and then use that money for whatever lending you are supposed to do it. But that doesn't really happen because people are happy continuing the way they want to. Of course, there are some restrictions also. For example, you have now retail Gavi trading, which is going to come. There will be some challenges out there. I mean, if you think through it logically, yes, buying retail Gavis is better than maybe investing into a bank deposit. But a gilt fund will still be better because a gilt fund will have some tax initiatives, tax benefits on that. And more importantly, have liquidity on that. If you have a small amount of Gavis that you're holding on any platform, it will not really be easy to sell it. But if you're in a gilt fund, yes, you can redeem it and then, put the burden onto the fund manager, so to speak. So a lot of innovations are coming. Getting them to get accepted, I think, is a bigger challenge. Getting new products, new innovations out. We already have, our platforms which are there, the India's home platforms, our borrowing, our trips platforms, all these are very, very good platforms. You don't have them in other countries. I worked in Singapore. I've seen how bond markets, the repos which happen out there, the settlements happen in a very, very different manner. We are much more advanced as compared to some of the other markets. But adapting something new, I think, is something which traders, investors both need to look with a very open mind.
So, Raja, I'd like to bring you in here. What, according to you, are the biggest challenges, data challenges facing bond traders, and what does it mean for investors?
As a trader or as an investor, the data challenge that I face at this point in time, for example, is quality of data, and the data may not be available in the structured or usable format. I don't think apart from that, we now in today's world face many data related problems. Of course, if some new product is there or some new entity is there, then we don't have the past history and all that. But that is not exactly a challenge in that sense.
Lakshmi, I'd like to ask you here, how are large corporations reacting to the bond market?
So, we discussed this earlier, the accessibility of capital markets to the, better rated or higher rated corporates is definitely a tad higher. It does not therefore mean that the lower rated entities are not able to borrow, but clearly the economies of scale favor the larger corporates. And so you are, able to see that whenever there are issuances from these entities, it just kind of has the required length and the breadth from an issuer perspective. And also for the corporates who are keen to borrow, for them the constant evaluation is how does it be cost effective. You've seen very recently, as I mentioned, because there's sluggish activity in the past 3 to 4 quarters, you've seen a lot of refinance activities, and clearly the capital markets are providing the required arena for corporate India to lower their cost of borrowing in this kind of a market scenario. We also have seen corporates become agile, given that interest rates are bottoming out, to come up with newer innovations by issuing floating rate instruments, for example, which is quite investor friendly as well. So yes, these are some of the ways we are seeing larger corporates react or respond to the current market dynamics and the scenario.
All right. And Rajay, what about the innovation on the supply side?
Floating rate bonds is one innovation that we have seen in the recent times. Earlier, government securities have come as a floater, but private sector corporate bonds, we are getting more and more number of inquiries, and we have seen some very, very successful floaters being issued by public or private sectors in the recent times. So that is one good development. We have seen, apart from that, other instruments also linked to market rate. So like T-bill related corporate bonds we have seen. We believe that green bonds and ESG have a very good future. Actually, we are getting inquiries, feelers from many, many corporates. So green and ESG space is where we see action. Infra has been there for quite some time, but it's not picked up, honestly speaking. But we believe that going forward, if the capex picks up, then infra again will have some traction. But that, of course, is not exactly an innovation. Apart from these things, we have seen some pickup in corporate bonds repo, and that is such a major development. Actually, we hope that this progress will continue, because corporate bond repo market will give an exit route apart from other this thing, and will improve liquidity. So that is another thing, not exactly an innovation, not exactly a new thing, but that's a very welcome development in my opinion.
All right, definitely that is a welcome development. But Rajiv, I'd like to ask you, what is your take here? What about the innovation on the supply side, and also what is your take on large corporations reacting to the domestic bond market?
I think the large corporations are the smart ones. They have benefited a lot. If you look at it, be it domestically, overseas, we saw HDFC's 81 just now, or even domestically for that matter. Most large corporates have benefited a lot and capitalized on the fact that interest rates are almost at an all-time kind of low, and they benefited from it. So to that extent, I think the larger corporates have benefited. The smaller ones, yes, that's where they have the challenge. Either they don't require the money, or they're not able to tap the markets with the same propensity that the larger ones can do. In terms of new products, innovations, of course, things keep coming, but on and off, we have seen some small innovations, which I think would happen more. Basic things which happen in the markets, like range accruals, where you have bonds which are linked, say, to the Nifty, to the inflation. It could be to dollar rupee. Some of them, of course, there are restrictions which you can or cannot issue. But these kind of things can help corporates also in terms of, if you have some sort of currency risk, or as an investor, you're interplaying between the equity and bond markets. So you have an yield pickup comes up at a particular Nifty level, or at a particular dollar rupee level. Those kind of products, we do need them, because not only will they give an opportunity to the issuer to borrow at a lower cost, the guys who are buying it get something different, and then there's a whole industry around it for bankers and other guys to structure it together, other products, other volumes pick up. So it's like an entire space gets created around. So there are a lot of opportunities. But I think the way to work around is obviously go and talk to the guys who want to buy. What exactly do you need? Many of these innovations, new things which have come up because mutual funds wanted it, and they are the ones who have wanted for the specific kind of products that have launched. So we need to talk to the investors as well, of course.
Absolutely, it is all about the investors. Mr. Shankaran, I'd like to ask you. There is so much of technology and tools which are creating immense opportunity, and as we discussed earlier, increasing transparency. So tell us a little about some of the tools which are available for traders, which enable them to make faster and better decisions.
So if you look at, I think one of the major developments in terms of transparency which came in global markets was MiFID II. So when it happened, obviously the buy side entities had to report price as well as liquidity of the bonds to a central entity, right? So this kind of allowed a lot of transparency to come into the market, which then resulted in more data being disseminated, which then allowed more and more participants to come in as well, right? So in exchange terms, even in the equity terms, as they say, liquidity draws more liquidity, right? So that's the way you look at it. So once you're able to do that, then you reach a tipping point, and liquidity starts coming in because of the transparency which is coming in into the market. The other development, we touched upon it earlier, but I can probably speak about it a bit more detail. The unstructured data which is coming out, right? So you have a lot of these messages coming in, and then you also have challenges around multiple venues in which some of these get traded. So obviously there can be different sort of platforms where it's getting traded. So getting prices from all of this together, and obviously applying some sort of a machine learning as well as an algorithm on top of it has actually helped look at comparable bonds and say, okay, this is the bond which I want to price, and this is where comparable bonds like this similar industry, similar sector is getting traded, and obviously similar tenor is getting traded, and how do I use all of this information together to create a price which I think would be relevant, and continuously apply machine learning on top of it. So we've had some successes over there globally. So for example, there's a partner of ours who bring in this very specific thought process to the bond trading workflow, which allows pricing of these bonds a lot easier, rather than leaving the traders scrambling for multiple data points, multiple comparables, and so on and so forth. It brings all of that together and then kind of brings a price transparency to the market.
What about SEBI's regulation? How is that
Yeah.
impacted?
So, I mean, if you look at it, I think one of the major changes which has happened recently, I mean, some of the base data itself is a bit of a challenge, especially in the corporate bond side, right? So, if I, let's say, for example, say, can I get my hands on the prospectus of a particular corporate bond? Sometimes, yes, it's easy. Sometimes it's been a bit challenging. So, I think that's the one of the key aspects around it is that if we are able to gather all of this with the depositories, I think that will bring in the base data which is required to do any sort of analytics on top of it. So if you don't even have the base data, what analytics do you apply on top of it? So that's been a key development. We'll have to see how that's executed. I think if that's executed well, I think it'll help bring a lot of transparency to the market as well.
Definitely. Lakshmi, would you like to add something here? What about the innovation on the supply side and its impact on investors?
No, clearly, I think I echo all the other fellow panelists' view. If you really need, innovation, it has to be mindful innovation. Point number one. Point number two is that you have to suit the interest rate scenario because in India, what happens is that if mutual funds are a large section of funding via the capital market route, the nature of their liability, which is the mutual fund investments, are pretty short term. So how are you going to, have something around the shorter end of the yield curve to make that segment more appealing? Because 15-year, 20-year kind of funding is seldom available from the mutual fund fraternity. Also, how you embed. The risk of interest rates through creative structures around the floating rate fund. We saw issuances come around linked to not just a treasury bill but also linked to the MCLR, etc. So I think all of that in combination, and as I said, having your breadth on the higher side, I think that's going to be the way forward. If you want to see sustained participation via capital market participants.
Rajay, I'd like to bring you in here. A pertinent aspect is the real inflation adjusted yields in India have been shrinking. So, what are your comments and the impact that it has subsequently on the Indian bond market?
Look, at this point in time, it's liquidity play. It has very little to do with any other factor. Market has huge surplus liquidity, as you know already. So long as the liquidity is there, yields will remain subdued. We believe that inflation is coming down and possibly we are in agreement with RBI projection on that. So inflation will remain below 6%. Liquidity will continue to remain like this for at least near foreseeable period, 3, 4, 6 months. Under these circumstances, any meaningful pickup in yield is difficult. Having said that, yields have picked up gradually in the recent times. After March, if you look at it, after April especially, even 10-year is now at 6.22 to 3%. So gradual movement is possible, but no significant or dramatic change in yield curve. That is what we believe. Inflation is coming down, so it will adjust over a longer period of time. But as I said, it's essentially a liquidity play at this point in time.
Shankaran, I'd like to bring you in here. What does it really take for one to be a successful fixed income investor? And how can they use data-driven insights to create a custom portfolio?
Yeah, so again, I mean, the biggest challenge in India is always liquidity. I think we will eventually have to address it in the form of data and analytics and execution capabilities. But having said that, today where we stand, if you look at it, I mean, the way people, let's say, for example, if I were to look at it, will I invest in NFT today if I'm a participant in financial market? Not, I would probably not, right? Because I would rather try and see how we could get that additional yield from the market. What risks is acceptable to me? So I think one of the ways a lot of fixed income investors investors and fund managers have started looking at it is, if I am investing in a particular company, how is the credit risk panning out, and what data do I have to assess this, and what informed decision can I take based on this data? So it can be as simple as saying, okay, how's the equity markets price performing if it's a listed entity, to saying, okay, how are the analysts perceiving this particular company? Is there any credit risk being perceived in unstructured data like transcripts and even for that matter in their analyst reports? What they're talking about it? How's their outlook looking? All of this will translate into some sort of a model which will then provide that insights whether the particular company's rating is getting downgraded or upgraded, right? So that's become a key aspect, because if we look at let's say a credit rating event to happen, a rating agency to come in and say, okay, this is what is the company's rating, sometimes it does take a bit of a delay in vis-a-vis a lot of things which are happening already in the market. So these market factors are going into some of these models which allow the fixed income investor to have a very faster view on that particular company which they have invested in the form of a corporate bond and the credit risk associated with it, and then eventually chase better yields associated with these companies.
Rajiv, I'd like to bring you in here. According to you, what is the best way to create a custom portfolio, and how can investors combat liquidity risk and interest rate risk?
I think these are not normal markets. I mean, from Feb 20, we've had a really, really different market. And it's largely been, not just in India, I mean, we spoke about negative rates and all just, no, they're all over the world. And it's largely been central banks calling the shots. So being guided by what the central bank is doing and not fighting them is, I think, extremely important as an investor or even as a trader for that matter. If you see for the past, year and a half, all the jumps or all the moves in the bond markets, be it, positive or negative, have happened around at the time of the MPC. Most of them, at least, or when RBI announcements have come through, mid-meeting. So a lot of the markets are, almost all of the market, at least as far as fixed income goes, or to some extent the currency markets, are being driven by what the Reserve Bank does. And they have a completely thankless job. You've got inflation, you've got growth, you've got all that supply coming in out there, and then you have a bunch of investors and traders who always want more, who are never satisfied. So it's a tough job for them. But given the current market, I mean, I would agree with the other panels. It's not been 6 months. You have a huge amount of liquidity, and that liquidity is not going to go away. Yes, interest rates are not going to go up, as in the repo rates are not going to rise fast, but they've actually already started rising. If you look at the 10-year yield, look at today's cutoff, I think after the cutoff also the bond has been sold off further. You had a slow glide in interest rates. We had a 10-year yield at 5.75, which has now moved to 6.25. And I think that's what the central bank wants. You probably by December, you'll see it at maybe 6.5 and further down to 6.75 by the year end. So understanding that trend, making sure that you call it right is, what you need to do. Obviously, I think everybody in the bond markets currently is largely risk averse. The markets are very, very rich in terms of carry. So you really don't need to carry too much of directional risk if you want to try and make money. You talk to any fund manager on the insurance side, mutual fund side, or even the bank books for that matter, most of them are very, very happy with the kind of carry which they're getting right now. So that's where you can make your money right now. It's not the time to go out and put on huge directional risk and then be beaten by your MTM all over the place. So you play the market as it is. Don't try and fight what is there right now. And yes, there's definitely a chance to make money.
Those were very useful tips there. But before we wrap up, I would like to ask Rajay, what if we take a forward stance? What does the road ahead look like for the domestic bond market?
It's very exciting. If you look at the development of corporate bonds market in India, it has been very steady and very secular. This year, it has been a slow start, all said and done. But with the economy picking up, I'm very sure that demand will come. Issuers will come, and with the initiative that the government is taking and various other measures, like for example, as I said, new products, new players like InvITs, ITF. There will be a growing market for pass-through certificates and new instruments like floaters, etc., or various market rate linked corporate bonds. I think we will see a steady growth in corporate bonds market. Look, what we need to understand is that corporate bond market in India is still very small. Around 36-37 lakh crores is the total outstanding. If you look at the contribution of LIC or NPS or EPFO, their investment, their contribution to corporate bonds is still not significant. So there is huge potential actually for the corporate bonds market to grow. If the liquidity improves, and as I said, if for example, if the corporate bonds repo market develop, banks and mutual funds also will have more confidence in this market. So all said and done, I think that it has a good future. As I said earlier, also green and ESG will make a mark this year, I'm very sure. Similarly, we hope, I mean, it's not exactly what we believe is going to happen immediately, but two things that we would like to see is one, growth in infra bonds, growth in long-term bonds. If you look at the long-term bonds outstanding, it's very, very small. And as all the panelists have already mentioned, participation by lower rated companies. At this point in time, AAA rated companies account for something around 75 to 80% by value and 25% by number. Let us hope that with growth of PTC market and other factors, as I said, corporate bonds, repo market, etc., we see more and more smaller players coming to this market. So that is what we think what is going to happen, and what should happen. Thank you.
All right. So there are some positive developments there. Lakshmi, before we wrap up, a quick takeaway from you on what do you think the road ahead looks like, and how should one build a perfect custom designed modern fixed income portfolio?
Yeah, the road ahead, as I said, there is always scope for improvement. You are likely to see many more newer types of instruments world over. ESG bonds are picking up in India. So far, we've seen ESG in equity space. We're yet to see a meaningful inflection point as far as ESG bonds on the fixed income space is concerned. I'd also like to see the derivatives market for corporate bonds develop, where you have credit default swaps as a mechanism for investors to hedge credit risks, which is quite popular world over. It's not yet fully developed in India. So a combination of all these tools really equip whether it's a portfolio manager managing a pool of investments, or a retail HNI investor or an institutional investor, to really have a fulfilling fixed income portfolio. Being mindful of the fact that you need to have all of these pieces into one bucket to ensure that there is reasonable stability, and the focus clearly being on the risk-adjusted returns rather than purely on returns.
Thank you, Lakshmi. And Shankaran, coming to you. What do you think? If we take a crystal ball and gaze into the future, what does the road ahead look like?
I think I will echo the exact same sentiments the panelists, right? So now, if I look at the new type of instruments which are being launched very recently, swaptions were launched, which is again a mechanism for various entities to hedge their interest rate risk in one additional way. So the more and more instruments like these are made available to market participants, the better it is, which is going to result in a better liquidity across various different types of instruments. So I'm quite excited on that front. If I look at obviously the issuance side, the supply side, so if I look at the infrastructure data which is there now, significant amount of projects are in the solar power sector, and which will obviously result in a lot more of ESG related issuances even in the bond side, and I completely echo that sentiment as well. So really exciting times ahead, and looking forward to a great 2022 as well.
Definitely. Those actually the kind of words we need to hear at this point. Mr. Rajiv, I'd like to just ask you, what do you think the road ahead looks like before we wrap up on this show?
I think things look good. One thing I will tell all bond investors is, unlike some of the other markets, the bond markets, at least in India, always give you a second chance. It's like you miss out one particular move, the next move is always around the corner. So it does give you a second chance. Having said that, I think there are certain things which should happen. I think since the time I started trading maybe 20, 25 years ago, we've always spoken about, corporate bond repos, etc. And they're always around the corner. They haven't come. I really hope that they do come around. And more importantly, in terms of issuances and raising money for longer term finance, that's something which is a prime need, which is there through and through. So longer term borrowing, the ability for companies to raise money for infrastructure projects, especially 10, 15, 20 years, that's not really there. There have been, of course, various structures which have come through, but they're more one-offs which have happened. To have a consistent market out there, that's something which will really help. It'll give volume to the market, it'll give gravitas, and plus it'll give investors who have been complaining very rightly that yields are not what they want or the returns are not what they want. They'll probably help them get those better kind of returns, be it a retail investor or a long-term investor who's running an insurance fund.
All right. Thank you so much for joining us today. And just to sum up, the road ahead does look positive, and fixed income as an instrument have been gaining popularity with investors looking for a steady stream of income, and those who want to avoid market volatility. And a savvy way to reduce risk that there is in this space is by diversifying and also by using data-driven insights and technology to make the right kind of decisions. So thank you all, ladies and gentlemen, for joining us, and we hope our audience has benefited from your insightful inputs. Thank you so much.
Thank you.
Thank you.
Thank you, Chira.
Thank you.
Thanks a lot. Thank you.
Thank you. Thank you.